So just like that, the market has corrected. So that was a pretty big sell-off today. We're gonna talk. We're gonna put it in context, right? That's what we do here, so we don't get battered around by the ups and the downs of the market. We're gonna put today's move in context. We've seen moves like this before, and actually relatively recently. We're gonna look at what that did and how the market responded to that move in the short term, so we can get an idea of what to expect tomorrow, as well as what the what the pullback ended up looking like. So we're going to talk about that, as well as add a hedge, add a trade that shows us some bearish signs, obviously with today's move, but because of its bounce intraday, it gives us a good opportunity for timing into that bearish trade. So let's go ahead and get started. Today is Monday, February the 24th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's take a look at the market forecast indicator on the S&P 500, like we always do. And you can see we kind of skipped through the light pink shading yellow line straight to the red line. That's how much we dropped. We dropped through the 23% retracement level, which again signifies that we've got a reversal, right? See, this one looks like it did, but actually didn't when the peak was right here. That had gotten to the 23% retracement level and then bounced off of it. And there was those opening gaps that we talked about. Those days when the market was gap, where most of the, if you recall, that week, most of the market's moves, those 4 days was like a 12-point gain. Like almost 10 of those 12 points came overnight. So very, very small moves during the day when most of the trading volume. So it was very, very tenuous. We talked about the possibility of those gaps filling because of that, and now it has, right? It took that long. It took about a week or so later, but in just 3 days, we've gone from all-time high to pretty much 5% off of the all-time high, which from a tweet I saw on Twitter, has never happened before when we've fallen this far. But in this case we have, and I've been talking about the things that you need for an intermediate pullback, for the green line to fall below 50, and one of them is falling below the 23% retracement level, and that's what we've done. So whether this is the low point or not, I don't think it is, because you can see there's some support down in this area. We still got some room to go. I do think, it was an extreme move today, and we'll talk more about what our expectations are going into tomorrow. But we did have the momentum line fall to just about the extreme low. The near-term line is in the lower reversal zone. That's the lowest point it's been during this whole pullback. See, we dipped our toe right there, and that ended up being the low point after a couple of days. We dipped our toe right there. Below, and we bounce off of that. Well, this case we actually are below, and we are below the 30-day pretty sharply here, with a red line. So even if we do bounce up tomorrow, I do think the green line is coming below 50, most likely. We were actually pretty close to having the orange line, the expectations of the orange line coming below 50 on this current pullback. I don't think that's the case yet, and you'll see why here in just a minute. But I do think there's some more room to fall, even if it's down to this 50% retracement level. Getting down into more in this area, 31.24. If you take a look at the Bollinger Bands for SPY, you can see, this is where we're at right now. So we're kind of hitting this volume node, and you can see there's not very much volume down in this area. That's where the retracement zone is. So, coming down to about 314 into this retracement area. Of course, the bottom of it's where your more significant support level is going to be. You can see how the bandwidth is really getting really rising up to the upside, but we're still not even below the lower band. So it kind of shows you how much how significant this move of, and also remember too, we're still way high up above. In fact, in our Market Outlook Live that we did today before the market opened, we looked at some of our old trades that we've been doing. We've got some trades that we've been trading for quite a while in our Market Outlooks. Again, if you check that out, if I know everyone asks, okay, can you follow up on those old trades you've done? Yeah, I do that every day. I do the Market Outlook. I do a Market Outlook Live video at 3:30 Eastern time. And we checked out a lot of our trades to see, okay, should we get out of them on this little drop? And we talked about what we should do with them, when we would get out of them, and a lot of them had this similar pattern where we are very, very high up above In fact, our trade idea of the day is going to look very similar to this. We'll talk about that towards the end of the video. So when you look at the DMI, the other thing that kind of stood out too today and with today's move was this DMI jumping way up above 40. That's a big time move. You can see, we've done this before, and that actually set the low point. We obviously the ADX rose from there, but the blue line just barely getting below 20. But in the past, that set the low point. So we had that kind of a drop and finished it there. And then we still were bearish for a while. We had a couple up days, some down days, a bounce, and then bounce back down. And then we eventually turned around and started this intermediate run, or this brief intermediate rally that we had. But that something very similar could happen here. We might go down a little bit more towards that 38% retracement level, bounce into this area. But with that, such an extreme low point, it's hard to see over here. We didn't get such an extreme low, and we continued down until we did, got the peak, and then that set the low point, and we rallied off of that. So just something to keep in mind with how extreme today's move was. If you look at some of the other indexes in the market forecast, obviously you are at the 38% level already on the Dow. Well, close to it. We need to move this up, don't we? So we'll move it up to there. We are through actually the 38% retracement level. We did hit an extreme low on the momentum line. You can see the near term, the intermediate lines making its way lower. Here is the this needs to be moved up too. Here's the NASDAQ composite. It's gone through its 23% retracement. Looks very similar to the S&P, since that's a big driver of the S&P right now. And look at the Russell. That's a horrible looking chart. Obviously breaking back down. Very bearish pattern on the market forecast with that intermediate line rolling over without getting above 80. So a brief bullish posture that did not get the new high, intermediate run that did not get the new highs, and rolling over. Very bearish. So I don't think... Well, I think there could very well be a short-term bounce because of how extreme today's move is. I don't think the intermediate pullback is done. There's still going to be some time. We might not go down much further, but we very well could, right? We can go down to 50% retracement levels very easy on this. So you saw on the S&P the potential it had. Well, if you look at IWM for the same pattern, we're not as high off the ground, but you can see we can pull down to this 160 level, and at that point there's going to be some significant support there. So, and that's just a little bit more ways down. So expect a little bounce, maybe another leg lower, maybe some bullish divergences coming off of that, and then we'll probably hit these support levels, bounce back up, and get going again. Because I don't expect a long-term drop out of this. More of a scare and a panic, and a lot of it coming in one session here. It won't be as big anymore going forward from here, but it doesn't mean it won't be down either. So there'll be some more ups and downs. I told you the other thing you need for near-term, for intermediate pullbacks is, sorry, not this one, is 1% declines. Well, we had a 3% decline. And you can see, again, we had one before over here the same day, and that set the low point. And then we had some more. Look, we had a 1%, 2%, we had a lot more big declines. But we also had a bunch of 1% rallies. I don't know if we'll get a 1% rally this time, but watch the open here where we opened up at 32.57. There's a good chance we just bounce at least right back up to that level. Kind of a dead cat bounce, and see if we break through that and we get to 3,200, really good. But if not, I had a student today in the Market Outlook Live, because I did an informal poll in my Q&A session that I have for our premium subscribers on Saturday mornings. And I said, okay, everybody, what do you think? Are we going to hit 3,400 first or 3,200 first? And it was kind of a mix. And I had mentioned that I do think that, that we are starting an intermediate pull. I didn't think it would happen this fast, but my vote was for 3,200, that we were going to hit 3,200 first and on a pullback, and then we were going to bounce back up. And shoot, I didn't know that, 48 hours later, after BYU knocks off one of the top teams in the country late Saturday night and sends our household into a frenzy, the rest of the market would be in its own frenzy, and the markets would be 25 points away from hitting that 3,200 target. So I still actually do think we'll get there at 3,200, and I think there's a good chance we actually pull down a little bit more, probably down to 3,175, 3,150 before we figure this out. bounce off of this and then get going again on the new bullish intermediate run. It's uncomfortable, and the reason why it's uncomfortable is because it lasted too long, and that's just the nature of when you get these intermediate runs that typically last 1 to 3 months, and we go over 4, then because it's so long and because we probably should have pulled back more at least here, if not earlier. The longer it goes without that pullback, with that normal exhale, then the exhale eventually comes, and it gets bigger and bigger. The bigger and deeper and longer the inhale is, the bigger the exhale is going to be, and that tends to be uncomfortable. And that's why you've heard me probably annoyingly talk about getting less bullish, getting less bullish, getting less bullish, getting less bullish, still being bullish, but getting less bullish. So you should have been far less bullish now than you were here, or especially way back over here. So today's going to hurt, but it shouldn't hurt very much for you if you've been watching these videos and you're one of our market scholars. It's still going to hurt, but it's really hurting for a lot of people that got more and more bullish the longer we went up and thought that that was a low point that we could bounce off of. And remember, I never mentioned that. I didn't ever think that this was a low that started a new intermediate run. I was actually surprised it lasted that long. And again, most of that move happened overnight on very low volume, and you can see how good those types of moves hold up. Or I guess I should say how well those types of moves hold up. My English teacher wife would probably kill me if she heard me say what I just said there. So that being said, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here on the bottom right corner of your screen. Hit that red subscribe button that pops out. There's also one down below the video. That will notify you when these videos are posted. Hit the thumbs up icon down below the video. That tells us 2 things. Number 1, you liked our video today. Number 2, you want us to do it again tomorrow. So quick way to give us feedback. You can do that right now while you're watching. That's our only survey. So we'd like this. If you don't like our videos, you don't have to click on anything. Also, while you're down there, comment. What did you get out of the videos today? What did you, what were you looking for? What did you get out of it? Why did you like it? Join our website at marketscholars.com. There's a link right there in the top right corner of your screen. You can click on that link to subscribe to our site for free. Follow me on Twitter for more content in between these videos, and join our Market Outlook Facebook group that we've created. And if you're watching this on our website, again, there's the link that takes you to our live Market Outlook videos that we do at 3:30 Eastern Time, the trade review videos, as well as putting on, like I said, we put on today's trade already before the market closes. That's a benefit sometimes when the market moves at the open like it did today. In fact, we put on Friday's trade idea, and I don't know if we would have got filled in on Friday's trade idea had we gotten in at the open today. So that's, again, kind of shows, and in fact we wouldn't have, and it's already doing really well. And we, like I said, that's the benefit of these videos. So check those out there. Again, those come with our monthly subscriptions. The Plus subscription is our monthly subscription. You also get access to all of our trading rooms, all 8 of them. Not the Q&A sessions, those are for premium subscribers, but you do get access to all the other 8 classes. So check that out. Again, it's a month-to-month thing. You can start and stop at any time. So I mentioned in Friday's video the likelihood that we would have a kind of a reversal candle here, a transition candle this week. Well, forget that. We're not going to get a transition because we already are bearish. So, and again, that's what that candle looked like over here. Let's see, let's go back. When was that day? It was back. When was that? No, it was further back. It was this one right here. So that was the other day that was so crazy, right? The big 3% move and the big move on the DMI. That was August the 5th. So let's go back to the difference between August the 5th and now. There's the week of August the 5th right there. And that was a Monday, just like today, right? The difference between then and now is that hit the 200-day moving average. And then we still, kind of bounced off of it. And here, we've got a lot of room to go to get to the 50-day moving average. In fact, it looks very similar to up here where we came down, early. This was the week of February the 5th of 2018, just to kind of give you an idea of what that looked like here. I need to go back further. Let's go back 3 years. So crazy to think that was 3 years ago. But there was August the 5th right there. So big down day like today, and we kind of had a little bounce back on Tuesday before falling the rest of the week. I don't know if I don't think because the risk appetite's not nearly as bullish as it was right here. All the different risk asset classes were so overbought. we're not so overbought this go around, but you get the idea of what can happen. So somewhere in between actually setting the low point because we hit the 200-day moving average there versus that big of an extreme because we were so far above the 200-day moving average there. Here we're pretty far above the 200-day moving average too, but I think we have stronger support levels, even like I said on the Russell too, that can hold us up. So expect more downside, probably a bounce tomorrow. We saw that here, we saw that on February. So expect a bounce off such an extreme tomorrow, at least in the morning, and then expect more weakness. Not so extreme, but expect more weakness to come after that until we really set this intermediate low point and get going from there. Let's take a look at the 3 green arrow chart. Of course, 3 red arrows now. This is a 3 red arrow signal that usually we bounce off of. I don't think we'll necessarily do it this time because we have such extreme volume, big time volume there. If you look at the 3 green arrows, you see how far we've gone away with 30-day moving average. So as we bounce back up, look for us to hit that 30-day moving average as a resistance level if we do. You can see that's what happened over here in that August, or this actually October. But back in October, you can see we came down, then we bounced up to it, and then rolled over. Same thing here, we bounced up closer to it, in this case to the 17-day by the time it had fallen through, and then rolled over. So, expect that. Expect to move up towards the 30-day moving average tomorrow before continuing to the downside, like I said. All right, now let's take a look at the volume chart here. So give me 1 second to pull that the 4-week chart. So there's all those gaps, right? That gap, that gap, that gap, all 3 of these, boom, 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 all filled in today, right? So we had filled in all the rest of these, and we still haven't filled in that one. That very well could end up being the runaway gap. There's a good chance we can fill in this one. So kind of watch for 326, 320, just under 326, right in that area, 326 and a quarter. Watch for that area tomorrow to be that's 4 points away almost, so that's a pretty decent move to get there. Watch for that resistance level there. You can see the volume node here, as we roll back over. I expect that we will roll back over from there. You can see on the 90-day chart, there's not very much volume support down below us until we get back down to 3110. So that's expect to move back up into this area and then a roll over back to the downside and probably down to this 50% retracement, which is the bottom of the value area and a volume node in this case, at least on the 90-day chart. Let's look at today's volume and trading range. The volume hit 160, almost 161 million. The trading range was 12 points. Those, needless to say, those are pretty extreme. Like 12 points is way off the charts. Obviously, we're well back above 1% now. And then the volume 170 million, also way up here. So those are very, very big numbers. Again, it's hard to follow through on such extremes because we really blow things out and you get bottom feeders coming in. So that's why I say expect a bounce tomorrow. The nice thing about the VIX is we did not close above 115%. We say just below it. 114%. That is a good sign, right? Getting above 115% suggests that we have a market sentiment pullback coming. So like this one here, when we closed over 115% in October, we ended up with a pullback, during that whole Q4 that lasted quite a while. Obviously, you go back further to that early 2018. We jumped all the way up well above 115%, so above to 132%. Again, that was early February, and that ended up being a pretty significant decline for a while. Market sentiment pulled back. Obviously, we had ups and downs, but it was a pretty significant decline for a while. So there's been other instances here where we closed just under 115%. This was 112%. That, as bearish as that was, ended up being an intermediate low point. That's at August 5th again. So very similar to what we're seeing here. So very good sign that we didn't finish higher than we did. I don't think we're coming down here for a while. We're going to have an intermediate pullback, which means we're going to have a fall. We're going to fall down. You can see we dropped back down below 20 in a few days before bouncing up and down, up and down, up and down. We really didn't get going until October. So this we could be weak for a month. Doesn't mean that we'll go down every day for a month, but we could have some volatility for a month before we finally get going and break that 15 and break the 90% mark again for good. And then that's when you start your intermediate run to the upside. So those are things to kind of watch, but don't expect it anytime soon. I wouldn't expect it this week or next week. And if it did, like heaven help us when we actually do have a decline, because if this can't start a normal exhale, if we just shallow like one day exhale and then we just inhale like there's nobody's business, like a college kid after a big test, then it's gonna, when we do have the normal exhale, it's gonna be very painful. So we do want to have we do want it to last a few weeks. We want the low point to set up. It will be a better low point for us to bounce off of if we spend some time hammering it out instead of just falling on one extreme day. I mean, like I said, that was the low point. Then it spent, a good couple of months, going up and down, even with a brief intermediate run before pulling back again, and then it got going. And that's kind of what we want to see. Maybe not 2 whole months, but at least a few weeks of volatility before we can bounce, set a good low, and then move up from there. All right, so to summarize, it was a down day today. A day like this was coming. Not necessarily a day like this, but a selling like this. It all occurred in one day. But probably I was expecting it would last a few more days than just one day. But selling like this was expected. The intermediate line doesn't stay above 50 forever. It's going to pull back. We've seen days like this before. The end of the world didn't occur. It's set low points. It doesn't mean that we'll bounce right off of it with a V bounce to the upside. But there's a good chance that the big selling is done. We'll probably go to lower lows. I expect that we will go to lower lows than what we saw today. But probably not, 12-point ranges anymore, and probably not 100+ million shares in volume. We'll have some heavy volume. We'll have some bigger than average days, but back in the tune of 4 to 5 points. We'll get that hammered, that low point hammered out, and then we can bounce up from there. So that's my expectations, and again with probably a bounce. We've seen days like this produce a bounce as quick as the next day. So that's kind of what I expect tomorrow, going into the rest of the week, and for that matter, the rest of the next few weeks. So what do you think? Do you agree with that assessment? Do you disagree? There's a link right there popping out in the top right corner of your screen. Click on that link. It opens up a poll. Then hit either agree or disagree. If you click disagree, comment below. If you're a lot more bearish than that, let me know. What are you seeing that would suggest that we got a lot more selling to go? Or you might think that, hey, it's probably going to be a good thing for us to V-bottom off of this because of something else that you're seeing that makes you a lot more bullish than I am. So just share what you're seeing, what charts, indicators, whatever it is that you're seeing that drives your opinion down in the comment section. All right, now let's talk about what's driving this price market. And of course, it wasn't Gonzaga losing. It wasn't San Diego State losing. It wasn't Baylor losing over the weekend. I don't even think really it was Bernie Sanders, even though he's gotten a little bit of credit. It wasn't Bernie Sanders necessarily. His election the primary results in Nevada that's driven it. I think it was this idea that the coronavirus, a lot of the potential impact of the coronavirus hadn't been priced in. The market was pricing the stock market. The rest of the markets, as I've shown you, the rest of the risk trade was definitely diverging away from the stock market. It was really only the stock market that kept going up, right? The bonds were going up, gold was going up. The rest of these different asset classes was definitely skewed towards the safety side. And so stocks finally caught up to what those other asset classes were saying. In fact, if you take a look here, let's look at the last 2 weeks. 2 weeks chart here, actually it's right here. So here's the last 2 weeks. Again, you can see bonds and everything were going up along with stocks. It was actually, let me go back further. Let me see how back I need to go, how far back I need to go. Let's go over here. It was right at that low, when we came off of this low point, the January 31st low point, that's it. That was, the stock market just like, okay, coronavirus is not that big of a deal. We had all those gaps that next week. It was not that big of a deal, according to the stock market. But you can see bonds kept going up. Real estate was really high because that's a physical asset. Bonds was going up. The dollar was really strong. Gold was going up. So there's bonds, right, coming off of this low point. So all these asset classes, in fact, we actually have to go to February 3rd, sorry. This is the end of January 31st, so February the 3rd right there. There we go. So all these, we started off strong. I mean, there's your stocks, there's small caps, emerging markets, real estate. But you see how this whole time that they were rising, I mean, we had some initial lows in gold and bonds, but they kept rising too. They kept rising, gold kept rising, the dollar kept rising, and then stocks finally said, okay, I think the stocks are like, we think they know something that we don't know. And so they came down, and that finally happened. And again, if that divergence doesn't exist, it doesn't happen this fast, but it does, according to these other asset classes, we should have been probably coming down from like this area right here, this peak. Instead of continuing higher, we should have come from here to there instead of from here up and then. So that's why it's so dramatic here, because of all these up days that all these other asset classes said probably shouldn't have had. Let's take a look. The dollar actually fell today, interestingly enough. If you take a look at the dollar index, coming off of Friday's move, and again, it's kind of more of an overbought pullback, I think, than a downward trend developing. If you look at the 10-year yield, I mean, that sucker's below 1.4% now. And I mentioned the idea that we could get a divergence, a bullish divergence. I've been talking about that. Again, sometimes I feel like I'm annoying you with all these themes that I talk about so much, and and then they finally play out, and it's like, well, I've been talking about forever. Well, that divergence, right? This lower low to about 1.25%, if not 1 1/3, but you've got the 1 1/3 there. I think we'll go a little lower, but down to 1 1/4, but with a higher low in the PPO, again, very similar to what we saw over here. I expect that to happen again. This is why I don't expect a recession to occur, because recessions don't start when the yields are already this low. Recessions start when the yield off of bearish divergences, not off of bullish divergences. Again, the market was looking for a recession back over here too, and we didn't get it. We continue to rise higher. So I expect a very similar pattern to occur again, especially with, again, how bullish gold is. I mean, again, look how bullish. The last time gold was this bullish was back at that same level when yields were so low. Again, this is not your typical pattern that you see going in. This bear markets kind of start when risk is excessive, and risk hasn't been excessive, and you've got a big time bearish divergence setting up on gold as well. That can play out pretty negatively, at least back down to this low point in between, which would be 1450-ish in that area. That's over 200 points away. So keep that in mind. Crude oil, we had that breakout move to the upside or downside. We kind of bounced back up to the 50. We're still in the bearish mode, and I expect with risk pulling back, I expect crude will probably pull back into this 47.5 area as well, back to where we got over here, and that's probably where it's going to figure out its low point before rallying and getting going again back to the upsides. All the risk trade, I mean, obviously it's showing bearish long-term patterns already as it is, all of them except for stocks. And stocks are just, like I said, just barely catching up to what all these other asset classes have been telling us for the last so many weeks, is that maybe stocks are more bullish than they should be. And I mentioned one of the great things about that low point, the bounce off the low point back in October, was that it was a very broad rally. And then I also mentioned that a lot of these, as bullish as we were here, the only other bullish chart that we saw was Canada. Everything else was not so bullish. Well, look at now. I mean, you are getting oversold cluster on UK, on Japan, but look at all, and Russia and Brazil. Look at all these charts. Dark pink shading, red lines all across the board. We have Italy with light pink shading and a red line. We have Canada and US. So, all these other countries are kind of showing us probably what's pretty, probably what's going to end up happening here in the U.S. And I can look at the same thing from a sector standpoint. If we look at the 12 grid for the sector rotation, and let's pull this up over here and look at the sector returns, you can see obviously energy still is just doing so poorly. But then there's your cyclical areas that drove the market up, and now they're driving the market down. And you can see some of these are going to be dark pink shading a lot quicker than others. Staples giving you that bullish bounce signal. Utilities and real estate pulling down a little bit, but obviously not as much. They're holding up. There's your safety trades up there holding up. With the dollar being down, materials actually did okay too, and industrials, energy is just kind of doing its own thing. It's, those stocks are just really struggling here as they have been. And again, the energy sector probably telling us something too, that the rest of these sectors weren't, about the impact of this coronavirus and how it could impact consumption, at least economic growth expectations going forward from here. And now you see we're catching up to where energy was already sitting. And again, it's not too often that we start bear markets with safety trades already overbought, as we see they already are. So again, expect some weakness. Just don't expect a long-term weakness, more of an intermediate pullback. Intermediate line falls below 50. Most likely not going to get the orange line falling below 50 though. So for our trade idea of the day, I did mention, this idea of being way up above the ground on the tightrope, right? Well, Microsoft is one of those stocks that we just pulled so far away from this value area and from this point of control. Very little volume up above us. And the nice thing about Microsoft is it's kind of bounced up well off of its lows today, but you can see how we just barely got below. You look at its market forecast, and it's not looking too hot. It's got that bounce signal, light pink shading and yellow line, but remember, as bullish as that is, if I expected the markets to bounce, I'd be looking at that like, whoa, we're going to buy this sucker up like crazy. But remember, bullish reversals tend to happen. Bullish reversals tend to happen with these same signals. Like when you get these signals here, you bounce back down, and we can reverse. And that, I actually expect the same thing to happen here. The getting these clusters, especially this one here, when we're mature in the intermediate run, rolling over, starting more of a bearish intermediate rally. If you take a look at its intraday move here, the nice thing is we kind of bounced off of this, and we got back up to these highs and kind of potentially dead cat bouncing, and that's when we made the trade. We actually made the trade here at the 1330 mark, and put that trade in, and so far it's been working for us. And the expectation is we bounce through these lows and make our way to the downside, and take advantage of this pullback. And if it doesn't, I'll talk about what trade I did. Let me finish going through some of these other charts and show you why I did what I did. So another reason is that negative line jumping up as much, but not so extreme, right? Like on the S&P where it sets that low. So I don't think necessarily this is the low. Again, especially too because we were so far up off of that value area on the point of control chart. And then you look at the long-term chart and you can see there's a big gap bigger gap than even on the S&P. The S&P was kind of flirting with these levels in January of 18. We were more bullish now on Microsoft than we were in January of 18. And that's all the pullback we had then. And the market had a much bigger pullback. I expect that, there's probably a little excessive in the risk here, and we'll take advantage of that. So what I did on this trade is I sold I bought the 162.5 put and sold the 60 put to cover most of the cost. So you can see my risk here, and I position size so that my worst case scenario on this vertical is a half of my normal risk. So I think there's a pretty good chance I can keep it to even half of that. So $550, that means I'm at 200. Was it 250? 275 is my risk. 275 right here. So it has to really bounce up a lot for me, basically filling in that whole gap for me to be able to get out even there. So I think there's a good chance I can keep my risk to that 275 mark. But for that 275, I got $2,200 of potential. And you can see the max gain is within one standard deviation. So there's a pretty good chance that we can get a good return on this. And that can act as a good hedge for us on a lot of those bullish trades that we're still in, for those of you who watched. who go to my directional options strategies class, where we do a lot of these directional type trades. We'll have that tomorrow. But also for those of you who watch that Market Outlook live, some of those bullish trades that we're still in, if they continue to falter, then this will be a good hedge for them. All right, so that does us for today. You've heard from me. Now I want to hear from you. Use that link right there to go to our Market Outlook forums on MarketScholars.com. That's one of the things you get for free when you subscribe to our site. But post any questions you have for me. Let's keep this conversation going before our video that we do tomorrow. And if you have any questions about what I covered or anything I didn't cover that pertains to this, obviously, let's talk about it. And you can also respond to anybody else's questions as well that come through. It's part of the community, right, and forums. So again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Follow me on Twitter for more content between the videos, and join our website at MarketScholars.com, as well as our Facebook group for our Market Outlook viewers. So again, thank you for watching. Have a great rest of your Monday evening, everybody, and we'll see you all next time.